Have you ever really stopped to think about what it means to own a share of a company? It's so much more than just a ticker symbol and a price on a screen. Today, we're going to pull back the curtain and really decode the language of investing, showing you how to use these things called per share metrics to see what's really going on inside a business. So, what does that one little share actually represent? Well, it's not just its stock price, it's your slice of the pie. It's a real claim on the company's profits, its cash, and maybe most importantly, its future growth. And we're going to show you exactly how to measure all three of those things using the very same tools the pros on Wall Street use every single day.
Okay, let's start with the big one, the absolute granddaddy of them all, earnings per share, or as you'll almost always see it, EPS. This is pretty much the bedrock of per share analysis, and it's a number you're going to see everywhere.
So what is it? Well, in simple terms, basic EPS answers a really fundamental question. How much profit did the company make for my single share of stock? It's a straightforward but incredibly powerful way to get a first look at how profitable a company truly is. Now, let's not get scared by the formula here. It's actually pretty simple. You start with the company's net income, that's the profit. Then you subtract any dividends paid out to preferred shareholders. Think of them as people who get paid first. What's left over is the profit that belongs to the common shareholders. That's probably you. You just divide that number by how many shares there are, and bam, you've got your slice of the profit pie.
Okay, let's make this real. Imagine a company made $500 million in profit. Let's say it paid out $50 million to those preferred shareholders, and there are 100 million common shares out there. You do the math, and you get a basic EPS of $4.50. That means for every single share you own, you have a claim to $4.50 of that company's profit. Simple as that.
Okay, sounds easy enough, right? But here's a curveball. What happens if the number of shares isn't fixed? What if it could actually go up? This can happen with things like employee stock options or certain types of bonds. And when the number of shares increases, your slice of the pie gets smaller. That's called dilution.
And that is where diluted EPS comes in. Think of this as the more cautious what-if version of the metric. It basically calculates the EPS as if all those potential new shares suddenly appeared. It's the number most serious analysts really focus on, because it gives you a much more conservative and, frankly, a truer picture of profitability.
So if you look at the formula here, you'll spot the key difference right away. It's in the bottom part, the denominator. We're now adding in all those potentially dilutive shares from things like stock options. This gives us that more careful, worst-case scenario view of the company's earnings power.
Now check this out. A real-world example from Apple back in 2022. Their basic EPS was $6.15. The diluted EPS was just a little lower at $6.11. So what does that tiny 4-cent difference tell you as an investor? It tells you that the risk of dilution at Apple was super low at the time. It gives you a ton of confidence in that earnings number.
All right, we've got earnings down, but here's a big question. Is the profit a company reports the same thing as the cold, hard cash it actually has in the bank? Well, not always. So in this next section, we're going to dive into that critical difference between profit and cash. You see, net income is, at the end of the day, an accounting figure. And accounting has rules that can be, well, let's just say they can be interpreted. But cash flow? That's the actual money moving in and out of the company. It's much harder to fake. That's why you always hear people say cash is king. And it's why smart investors love to look at cash flow per share, or CFSP. Now, another incredibly useful metric is something called EBITDA per share. Whoa, big acronym, I know. It stands for earnings before interest, taxes, depreciation, and amortization. The whole point is to strip out a bunch of financing and accounting decisions to get a really pure look at the company's core business performance. It's perfect for comparing two companies in the same industry, like comparing apples to apples. And the best part is the formula is super straightforward. You just take that EB8A number and divide it by the number of shares. This gives you a really clean measure of a company's operational horsepower on a per-share basis without all that accounting and financing noise getting in the way. So let's just pull all this together for a second. Think of these three metrics as different lenses to look at a company. EPS tells you about its bottom line profitability. CFPS tells you about its real-world cash-generating power. And EBITDA per share gives you a clean look at its core operations. Each one tells a crucial but different part of the story.
Okay, so the company is making money. That's great, but how does that value actually get into your pocket as an investor? Let's talk about that next.
This is the part investors tend to love, right? Dividends per share, or DPS, is the actual cash a company pays directly to you for each share you own. So, for example, if a company has a DPS of $2 and you own 100 shares, you're going to get a check or a direct deposit for $200. It's your tangible cash in hand return.
And the formula for it, as you can see, is as simple as it sounds. You just take the total amount of cash dividends the company decided to pay out, and you divide it by the number of shares. That's it. All right, so when a company has a big pile of profit, it hits a fork in the road. It faces this really critical choice. Does it pay that money out to shareholders as dividends, or does it reinvest that money back into the business to fuel future growth? This is a huge strategic decision.
And that decision is measured by two sides of the very same coin. On one side, you have the payout ratio, which is the percentage of earnings they give to you. On the other side, you have the retention rate, which is the percentage they keep to reinvest and grow the business. This chart makes it crystal clear, right? The payout ratio and the retention rate have to add up to 100% of the earnings. A company with a high payout ratio is great for investors who want income right now, but a company with a high retention rate, well, that's a bet on much bigger growth tomorrow.
And that brings us to our final metric, the sustainable growth rate, or SGR. This is such a cool concept. It tells you the maximum speed a company can grow using only its own profits. No borrowing money, no issuing new stock. And guess what? It's directly tied to that retention rate. The more a company retains and reinvests, the faster it can potentially grow all on its own.
And that is a powerful, powerful signal for an investor. A high SGR means the company has this strong, self-funding growth engine. It doesn't need to go into debt or dilute your ownership by issuing more stock to expand. It's growing from its own strength. So, what's the bottom line here? These per-share metrics are an absolutely essential toolkit for any investor. But as this final question shows, one number alone never tells the whole story. If you see high profits but low cash, which one do you trust? By looking at all of these metrics together, you start to see the complete picture of a company. And that, my friends, is how you make smarter, more informed investment decisions.